Thank you for staying tuned. Nigeria's headline inflation rate eased further in March to 11.25% year-on-year from 11.31% in February 2019. This is the third consecutive month of decline in the figure. Well, let's make a better sense of it on our domestic commodities market update with Fumi Adebowale, one of the research analysts with Financial Derivatives Company. Hello, Fumi. Good afternoon. Thank you for coming through to us.
Good afternoon. Thank you for having me.
So the MBS released its inflation data this morning, and as widely expected, the headline inflation declined for the third consecutive month to 11.25%. What is responsible for this declining trend, and is it likely to be sustained?
Yes, like you said, the inflation numbers were released this morning, and as widely anticipated, the inflation numbers declined by 0.06% to 11.25%. Then by headline inflation, what do we mean? We mean the year-on-year change in the general price level. So that means that the rate of increase in the prices of commodities declined in March 2019 compared to March 2018. Also, what's mentioning is that all other sub-indices, with the exception of month-on-month, also move in the same direction with the headline inflation. Now, what are the factors responsible for this decline? In the month of March, we saw that there was relative stability in the exchange rate. At the parallel market, we saw that the exchange rate traded relatively stable within the band of 360 to 362 naira per dollar. Apart from this, we also saw that there was a strain on liquidity, and that was due to the CBN's aggressive liquidity mop-up through stabilization securities and OMO activities. The net OMO outflow in March was 2.04 trillion naira. So as a result of this decline in liquidity, we saw that the pressure on prices declined because demand will definitely decline and pressure on prices declined. So that was those were the factors that led to the reduction in the headline inflation. And in the near term, we do not expect this downward trend to persist. And that is due to some inflation threatening factors such as the implementation of the minimum wage that will increase disposable income and also increase demand. We also expect the planting season to commence in Q2. That will reduce output. So with reduction in output and increase in demand, we expect pressure to start mounting on prices, and that will reverse the declining trend that we've been experiencing since the beginning of 2019.
Food inflation has declined for 3 consecutive months now. That's in spite of this, we've seen commodities such as yam and other tubers recording an increase. Why is this so?
Yes, the food inflation declined by 6 basis points to 13.45% in March. However, it is worthy to note that the rate of increase has slowed significantly. So this implies that we could likely see a reversal in this trend. Meanwhile, despite the decline recorded between January and March, we saw that the price of commodities such as yam increased. And this is because yam has 2 planting seasons in Nigeria. We have the November, December, and we also have the March, April. So this is reducing output in the market, and that is putting pressure on prices.
Now, is the decline in headline inflation likely to influence the MPC's decisions at its meeting? That's on May 20 and 21st.
Yes, at the last MPC meeting, the decision to reduce the MPR by 50 basis points was premised on moderation in inflation, exchange rate stability, and the need to boost economic output. However, we expect policy decision at the next meeting to be driven by inflation expectations rather than historical data. So this means that the possibility of the March inflation number influencing the MPC's decision is very, very low. And we also expect another inflation numbers in April, and our expectation is that inflation is going to increase in April. So this is likely to feed more into the decision of the MPC committee at the next MPC meeting.
All right, thank you very much, Fumi, for your time. Fumi Adebowale is one of the research analysts with Financial Derivatives.